Welcome. In this video, we're going to discuss capital budgeting. Capital budgeting deals with one of the three primary activities that all businesses engage in, and it's a useful way to think about a business, and it's a very useful way to understand financial statements. All businesses engage in operating activities, that is, doing what they do, investing activities, in other words, investment in the infrastructure and assets that are necessary to support those operations, and then financing activities, which is how they finance that investment. An income statement will break out how well a company has performed, and as we've discussed previously, an income statement focuses on functional relationships such as gross profit, operating income, taxable income, and ultimately net income. The balance sheet focuses on the financing and investing activities. The asset side of the balance sheet, or the accounting equation, shows us what our assets are, and the liability and equity side of the balance sheet, or the accounting equation, shows us how we have financed those assets. The different options being through debt or equity or retained earnings. Capital budgeting deals with investing activities. As we previously stated, decisions should be based on a cash flow analysis. What we're adding now is the idea that it should be based on a discounted cash flow analysis. By discounted, we're recognizing the fact that money has a time value. And there's two reasons why money has a time value. One is the fact that if I have money now, I can put that money to work and it can earn something for me. So $1 is worth more today than it's worth tomorrow because I can put that dollar to work and it can earn interest. It can compound interest. When we talk about going forward, we're talking about compounding of interest. Likewise, I might prefer to have $1 today as opposed to $1 tomorrow because of purchasing power. In other words, what that dollar can buy. If my currency is subjected to an overall rate of inflation, which is a sustained overall increase in the price level, then what happens is my purchasing power decreases over time. And so that dollar today can buy more today than it will be able to buy tomorrow because of the decrease in purchasing power. When we talk about time value of money, we are focusing on the earning power of money, not on the purchasing power of money. That would be dealt with in another way. So in a capital budgeting scenario, we want to be methodical in how we approach our problem. And the very first step we're going to have is going to be to try to capture, or not to try, but to capture our cash flows and then lay them out in a timeline. So let's use this problem here to illustrate the various different capital budgeting techniques that we'll be talking about. Here we have a guy who's contemplating retiring in 5 years. He's looking at the possibility of opening a self-servicing car wash, and he has obtained a certain amount of data regarding the investment that would be necessary, the type of revenue he could generate with this car wash, so forth and so on. So we have the various data in this problem. We're also told that the individual will not open the car wash unless it's able to provide at least a 10% return on his investment. And then we have some required items, and as is the case in working these problems, I'm not particularly interested in what they're asking me to do. I'm more interested in figuring out everything that's going on, and then I'll be able to answer any type of question they might have. So the first thing we're going to want to do is take this data and create information. I'm going to start with the information that we're given regarding sales. We're told what the sales price. This car wash is going to offer two services, a car wash and a vacuum service. And we're told what the sales price is of each of those two services. And we're told what the gross receipts for the car wash would be per week. With that information, we can ascertain what the gross sales would be for the vacuum service, and we can also determine what our weekly volume is going to be. So for example, if I'm told that I expect to have weekly sales from washing of $1,350 and my sales price is $2 per wash, then that means my weekly volume is 675 washes per week. We're also told that the ratio of the vacuuming to washing is 60%. So if my weekly sales is $1,350 in wash, it's going to be $405 in vacuums. Likewise, if my sales price for vacuums is $1, which is information that's given, then I can determine that my weekly volume is 405 vacuums per week. Or another way I could have done it is simply take 60% of the 675. Next step would be, and we'll lay this out here in a moment, would be to get data on our various variable costs. So we're told here the only variable costs associated with this operation would be 20 cents per wash and 10 cents per use of vacuum. Then we know we have fixed costs here. We're told that in addition to rent, we have monthly costs of operations for cleaning, insurance, and maintenance. And then finally, we know that we're going to have to make some type of investment, and that information is given up here. We'll have a 5-year lease at a cost of $1,700 per month. That's an additional fixed cost. The purchase and installation of the equipment will be $200,000, and then we estimate that we can sell it at 10% of that cost, or $20,000. That would be its salvage value, and we will also have to make an investment of $2,000 in working capital. That means increased level of items such as inventory, receivables, and so on. When we make an investment in working capital, that is liquidated at the end of the project. So after 5 years, that working capital level would go back down. Now, where students often have an issue in capital budgeting problems is in properly identifying all of the relevant cash flows. So there are a couple things you should automatically do at the outset of any of these type of problems. Number one, you know there's an investment. Because there's an investment, that means that investment can be depreciated. So you would want to go ahead and calculate your depreciation. To the extent that taxes are involved, there will be a tax effect to a depreciation. So this might not be stated in the problem, but it's implied. I buy an asset, I can depreciate that asset, and that depreciation is a tax-deductible expense. So right from the get-go, I want to get my depreciation sorted out. Secondly, I'll be disposing of the asset at the end of the life of the investment project. And at that time, there may be a gain or loss on the disposal of that asset. So I want to, again, capture that. So before I go any further, I want to make sure that I identify these things because they're easy to overlook. So we're going to sort out what our depreciation expense is going to be right up here and what any tax effect related to that is going to be. And then over here, we're going to sort out what any gains or losses we're going to have on the disposal of that equipment at the end of its life is going to be. So assuming a tax rate of 0, we have a historical cost of $200,000. We estimate that we will sell the asset at the end of its life for a salvage value of $20,000. That gives us a depreciable base. The depreciable base is the total amount of depreciation expense that I'm going to recognize over the period that I depreciate the asset, irrespective of what depreciation method I use, whether it's straight line or some type of accelerated method. So we're only dealing with a simple method, which is straight line depreciation. We're going to depreciate this asset over 5 years. So the amount that's going to be depreciated is $180,000, my depreciation base. That will give me an annual depreciation of $36,000. This is a tax deductible expense, and so I would determine what my depreciation tax savings would be at this point. Now, because my tax rate is equal to 0, I don't have any depreciation tax savings. But were my tax rate to be something other than 0%, then there would be a tax effect associated with depreciation. And once again, the common mistakes that are made in these types of problems is leaving something out. So that's why it's a very good idea before you get started on anything else to make sure you get this type of information sorted out. What's my depreciation? What's my associated tax break with that depreciation? Now, when I sell the asset, that's over here, the way that I calculate whether I have a taxable gain or loss is I take my proceeds from the sale, I take my book value of the asset. The book value of the asset is the historical cost less the amount of accumulated depreciation. Well, after 5 years, I will have accumulated depreciation of $180,000, so my book value is equal to $20,000. I have no gain or loss, and therefore I obviously have no tax effect. So this gain and loss scenario is correlated to this depreciation scenario. What would happen if I decided to estimate my salvage value to be 0? That means that my historical cost would be $200,000. My estimated salvage value would be 0, so my depreciable base would be the full $200,000. That would give me an annual depreciation of $40,000 a year. Again, I would calculate what my depreciation tax savings would be, but again, that's going to be 0 because our tax rate's equal to 0. And then under this scenario, if I sold the asset over here, and if I actually sold it for $20,000, my book value will be zero. Again, book value is historical cost less the total amount of depreciation recognized, which is going to be the depreciation base. So that's going to give me a book value of zero. So I'm going to have a taxable gain of $20,000, and I'm going to have a tax effect with that. So going forth in this problem, we will assume this first scenario here that we're going to estimate our salvage value to be the $20,000. So this will be our depreciation expense, and then this will be the amount of gain or loss that we have. Okay, my next step would be I've dealt with the effects of purchasing the asset or making the investment, the idea that number one, I have to make it, I will depreciate it, there will be tax effects to that depreciation, I will sell it, there may be tax effects to the sale of that asset. Now I'm going to deal with my operating cash flow. In other words, why did I make the investment in the first place? And there's two general reasons. One is I'm going to either increase operating income, or I'm going to decrease my expenditures. So in this case, it's going to be an increase in operating income, so we need to calculate that. So if we come up here and we set this up like a cash flow statement, we're going to determine what our total cash receipts, estimated cash receipts would be for a year. So there's 52 weeks in a year. We expect to sell 675 washes per week at $2 per wash. So that's an estimated $70,200 of revenue from washing. For vacuuming, 52 weeks in a year, we expect to sell 405 washes per week at $1 per wash, so that's $21,060. That gives us total cash inflow of $91,260. Then we can come down here and look at our variable costs, follow the same logic. The water used in a wash, we got 52 weeks in a year, we'll have 675 washes per week, is 20 cents per wash. So that's going to give us a variable cost associated with washing of $7,020. Likewise, the electricity related to vacuuming, we've got 52 weeks in the year. Every week we expect to vacuum 405 times, and that's going to cost us 10 cents per vacuum for a total of 2,106. So we have our total variable cost, our total revenue, our total variable cost, and our contribution margin. Then we're given information on our fixed costs, our operating fixed costs, which includes rent, cleaning, insurance, and maintenance. We're given that information on a monthly basis. So here would be our calculation for the annual amounts of each one of those expenses, total fixed costs. This gives us our operating cash flow. We would calculate our tax effect, again, because our tax rate is equal to zero. There is no tax effect related to this cash flow. And so our net operating cash flow is $49,434. That's one way to do it. Here's another way to do it. I'm going to calculate the contribution margin for each one of my services. So if I start up here with washing, I know that there's 52 weeks in a year. I will sell a wash for $2. I'll have 675 washes per week, for a total of $70,200 in sales related to washes, and I will match that up with the variable cost of washing, which is 20 cents per wash. So that's $7,020. That gives me my contribution margin from that particular service, washing. And then I do the same thing down here for vacuuming. I get my contribution from vacuuming, I add them together. There's my total contribution. It's exactly the same as what it was up here. Here what we've done is we calculated cash inflows, variable cash outflows, contribution margin. Here what we've done is we've calculated the contribution for washes and then the contribution for vacuums, total contribution, subtract out the same amount of fixed costs, gives us the same operating cash flows. Again, the tax effect is equal to zero because our tax rate is equal to zero, and our net operating cash flow is equal to $49,434. Okay, the first method we're going to look at is the payback method. Payback method is a non-sophisticated method because it does not incorporate the time value of money, and the payback method simply tells us how long it takes to recover our initial cash outflow. So pros and cons of this, two pros. One, we are dealing with cash flows. Two, it's simple. Cons with this, what happens if we have cash outflows that occur later on? What happens to cash flows that happen beyond the payback period? Those are the primary negatives about this method. Anyway, this is how we would go ahead and determine what our payback period is in this situation. Over a 5-year period, in year 1, we're going to have an initial investment of $200,000, working capital investment of $2,000. So our net cash outflow in year 1 will be $202,000, and then in every one of the subsequent 5 years, we're going to have operating cash flows of $49,434. Again, we have no tax effects, but I've set this thing up so that if we were to introduce a tax rate, we would be able to readily see what those tax effects would be for each related cash flow. In other words, there's a tax effect related to this operating cash flow, and then there would be a tax related to the depreciation. Notice that in the last year of the investment, I disinvest, I sell the asset for $20,000, and then I likewise reduce the amount of my working capital. Now here's a point of confusion. A lot of times students, every cash flow has a tax effect except for working capital. Working capital is simply means I've got more money tied up in my working capital accounts. Generally, that would be inventory and accounts receivable. That is not a taxable activity or taxable transactions. So the best way to keep this straight is for any given activity, it has a tax effect or a potential tax effect, with the exception of an investment in working capital. There is no tax effect related to any changes in working capital. Okay, the next method we're going to look at is called the accounting rate of return. Actually, in the last chapter of this book, we'll revisit this topic. We'll call it return on investment. They are essentially the same thing. This is a terrible method for making capital budgeting decisions. It's problematic for a whole multitude of problems. Not only is it an unsophisticated method, but it is also a method that includes non-cash flows. Depreciation is incorporated into this since we're working with net income, and depreciation is a non-cash flow. All kinds of problems with this. Why do we even talk about it? Because it's used to a reasonably common extent. Why is that? Well, the reason that accounting rate of return, the general reason that accounting rate of return would be used for making investment decisions is because the person that's in the position of making those decisions is being evaluated by return on investment, which is essentially the same thing. And so at the end of the day, if you're going to evaluate me on a given metric, I'm going to look to maximize that metric, even if that metric is insufficient in terms of doing what we're trying to do. Also, I forgot to mention that payback is not a particularly good method for capital budgeting. In fact, I'd say it's a pretty poor method for capital budgeting, but it does have one really useful aspect, and that is from a risk perspective, because what payback tells me is how quickly I recover my cash investment, and that can be very useful in terms of analyzing the risk of competing projects. Don't ever forget, when we're engaged in capital budgeting, we are working with pro forma numbers, and the farther out my numbers are, probably the less certainty I have about those numbers. Okay, now let's take a look at net present value. What I suggest you do, there's multiple ways of setting this up, but the way I would always encourage students to set this up is to lay out a timeline like we have right here. I have my 6 different periods, and then lay out every individual item right here. You can work the problem quicker if you combine things, but if you combine things, then you lose information. And generally, that's not a good thing to do. It makes it much more harder to audit what you're doing. It makes it a lot easier to make a mistake. So the more you lay stuff out in terms of breaking your work out, the better off you're going to be. All right, so in time period 0, what's going to happen in terms of cash flows? Well, we're going to purchase the equipment, and we're going to make our investment in working capital. So the net cash flow for time period 0 will be the $202,000 outflow. In time period 1, we're going to have an operating cash flow of $49,434. There is no tax effect associated with depreciation because our tax rate is equal to 0. There is likewise no tax effect associated with that operating cash flow because our our tax rate is equal to 0. So our net cash flow for that year is $49,434. That will be the same for the next 4 years, and then in the 5th year, what's going to happen? We'll have the same operating cash flow, but we will also have the disposal of the piece of equipment for $20,000, and we will have the release of the investment in working capital for $2,000. So our operating cash, or not our operating cash flow, but our net cash flow in year 5 will be $71,434. Now this step that we just completed is the most crucial step in this, and that is properly identifying all of the relevant cash flows. How we go about solving the problem from that point forward, there's a couple different ways we can go. In this particular case, I utilize the discount factors, which are in this row right here. In other words, I discount those cash flows back to time period 0, add them all up, and that gives me my net present value, which is a negative $983.14. Now, in order to discount these cash flows back to the present, I must have a discount rate, and that discount rate in this case was 10%. So I use 10% because that's what this guy said he wanted to earn on the project, so we can see that discounting the expected cash flows in this project at 10% leads to a negative net present value, and he would not be interested in the project. An additional way to do this without working with the present value factors is simply use some Excel functions here. So I can calculate the net present values using an Excel function. Likewise, I can calculate the internal rate of return. The internal rate of return is that discount rate at which the net present value would be equal to 0. So in order to do that, we would use the following Excel function. My discount rate's 10%. My operating cash flows over the life of the project, or not my operating cash flows, but my net cash flows over the life of the project, and then add the cash flows from time period 0, and that gives me a net present value of $945,000. The advantage of learning these Excel functions is extremely handy. I just calculated my net present value. I can now calculate my internal rate of return. My internal rate of return is going to take all of those values, and I get an internal rate of return of 9.83%. Logically, if I discounted these cash flows at 10% and I got a very small negative net present value, I would know that my internal rate of return is less than 10%. How do I know that? Because my net present value is negative. Furthermore, I know that it's just a little bit below 10% because I have a very, very small negative net present value. Now let's take a look at the same problem, but we'll start to work with some tax rates. Here I'm going to assume that the tax rate is equal to 10%. Okay, that has no impact on my calculation of depreciation. However, it does have an impact on my depreciation tax savings. In this particular case of calculating depreciation, I am only going to depreciate $180,000 over the 5-year period, so my book value will be $20,000. So when I dispose of the asset, I will have a gain or loss of 0, so there will be no tax effect. However, if I had chosen to use a salvage value of 0 and depreciate a full $200,000 over the 5 years, then I would have a book value equal to 0. If I were to sell the asset at $20,000, I would then have a $20,000 taxable gain, and there would be a tax effect of a negative $2,000 or a cash outflow of $2,000 on that taxable gain. All right, we're sticking with this depreciation scenario right here. The calculation of my operating cash flow is unimpacted by taxes. However, the tax effect is obviously impacted. So the result here is that my net operating cash flow is decreased by the tax effect related to my operating cash flow. And again, I can do this one of two ways. I can either do it in terms of total receipts, total variable disbursements, calculate my total contribution margin, then subtract out my fixed costs, or I could do it by each service by calculating the individual contribution margin. Which method is better? I myself would probably prefer this method because this gives me more insight into how valuable each one of these services are, how much they impact my overall contribution, my overall profitability. Okay, so if we came down here to payback, assuming a 10% tax rate, what's going to happen? Well, we're going to have a negative tax effect that's related to our operating cash flow that we calculated right there, and we're going to have a positive effect that relates to our depreciation. In other words, depreciation is a tax deductible expense. It reduces my taxable income, and therefore it reduces the total amount of taxes I pay. So the tax effect of depreciation is positive. So here we have our net cash flows for the 5 different years, and we can see that our payback would be here between the 4th and the 5th year. Now if I come down here and look at the accounting rate of return, I can calculate this in a couple different ways. I'm going to do it in a straightforward income statement way. I have my net operating income. From that, I'm going to subtract my depreciation. That allows me, my calculation is earnings before taxes. My total income tax would be $1,343.40, which is actually the difference between these numbers right here. And that gives me a net income of $12,090.60. And so my accounting rate of return, or essentially my return on investment, would be 5.99%. Come down here to the calculation of my net present value. We have tax effects from these cash flows right here. We have tax effects from depreciation. And you can see here that as a result of increasing my taxes from 0 to 10%, had what impact on net present value? Well, this project was unprofitable initially with no taxes. I think we had a negative net present value of $945 and change, but that net present value has increased to almost a negative $20,000. Likewise, if we come down here and calculate our internal rate of return, I believe the original internal rate of return with the tax rate equal to 0 was about 9.8%. So our internal rate of return has been reduced down to 6.32%. Now let's look at what happens if we raise the tax rate to 20%. Okay, my depreciation again is unaffected. However, my depreciation tax savings goes up as a function of the increase in the tax rate. Likewise, over here, I'm not going to pay any taxes on a gain because I won't have any gain because my book value will be equal to my proceeds. But were I to depreciate this thing, use a salvage value of 0 and depreciate the full depreciation base, then I would end up with a taxable gain, and that would be taxed at the tax rate. So that would I would have a corresponding cash outflow of $4,000 in year 5. My calculation of my operating cash flow is unimpacted by any change in my tax rate. However, the tax effect is obviously impacted. It goes up as my tax rate goes up and my net operating cash flow goes down. What happens to my payback? My payback period is probably going to be a bit longer. It's still between year 4 and 5. My accounting rate of return is going to be decreased. And over here under my net present value, the impact of raising my taxes from 10% to 20% was to increase the negative, which was to decrease the present value of my project from a negative approximately $20,000 to almost a negative $40,000. Likewise, if I looked at it in terms of my internal rate of return, we reduced the internal rate of return. I believe it was something around 5% down to a little over 2.5%. So I've always been amused by politicians getting out there making comments about taxes, raising, lowering taxes, so forth and so on, and having people argue, well, it doesn't have any impact if you change the tax rates. Well, we've just demonstrated right here that as the tax rate goes up, what happens to the present value of the project? It goes down. What happens to the internal rate of return? It goes down. So given that investment along with consumption are some of the drivers of the economy, the argument that changes in tax rates do not have any impact on the overall health of the economy is obviously a demonstrably false argument. Okay, that's it for capital budgeting.